Welcome to Mortgage 101. I'm Jill Franks, and next to me is my coworker, Emma Davis, and together we make up the marketing team here at Farmers State Bank. And we are so excited to be here today to give you some awesome information about our mortgage team and our mortgage lending process.
Yeah, we are super excited. So thank you to those of you that have joined us this afternoon. We're doing something a little bit different with our lives now. So if you're on and you're watching, we'd love it if you'd maybe just shoot us a little comment or maybe your favorite emoji, something just to let us know that you're watching and tuning in. But today's guest is going to be our Chief Executive Mortgage Lender, which is John Streuter. Hopefully, some of you have probably worked with him, you know him, or after this video, you will hopefully work with him in the future. He has over 36 years of mortgage lending experience that has taken place here in the local area, and so we're super excited to have him this afternoon.
We are, and we're so grateful for his time. And he's so busy right now with all of the refinancing going on and everything, and just an expert in his field. Any question that I've ever had about mortgages, he's been able to answer, no problem. So before we bring him on, we do want to kind of just go over a few things and how today will work. We have some pre-submitted questions that we've received throughout the month that we've had this live event posted on the internet, and we have those queued up and ready to go, so we want to make sure we get those. But in the meantime, while we're chatting and answering some of those questions, feel free to throw in the comments your question. We'll get to them as soon as we can, and be sure to include those. So, yeah, should we bring them on?
Yeah, I see 𝗍𝗵𝗶𝗲𝗳 said hello. Hey, Ijn, we're so happy that you're on this afternoon.
Yes, and Katie, so glad to have you as well. All right, let's bring them on.
Hey, John.
Hey, John.
Hello, everybody. Excuse me. How's everybody doing today?
Great. We're so glad that you're able to take the time out of your day, John, to be here with us to answer some of these mortgage questions. I know one of our top questions that we get from customers all the time on social media always revolves around mortgage lending. So this will really help Emma and myself, as well as everybody I'm sure tuning in here, to really be able to give a response to those questions. So.
Sure. I'm happy to be here and give you the time and answer any questions for anybody that's out there on the live web. And I always enjoy working with borrowers that have questions. I get borrowers that say, oh, I'm sure you're tired of the questions. And one of the things that I really enjoy is being able to lead somebody through the process, because I know how complicated it can be.
Yes, definitely. John, do you want to go ahead and maybe, I know you have this huge long history in the mortgage lending department. Would you just kind of give us a little bit of background about your experience?
Sure. I've been in the mortgage business since I was 21 years old. So if anybody wants to do the math, they'll find out how old I am. But been doing the business for 36 years. Actually started in the collections end, as many of us would do back in the day, and then work my way into the lending area. I've gone through different programs. I've been to Freddie Mac underwriting school. I've been originating loans for probably 32 of those 36 years, and have worked for some larger corporations that had facilities in Southern Illinois, and Farmers graciously asked me to come aboard about 4 years ago, and I've been working with Farmers to get us back on top, and we actually accomplished that goal this last year. We were #1 in Williamson County for mortgage recordings. We were a close #2. We were #2, but close behind in Saline County. So we're the place for people to come to for mortgage business.
That's awesome. I know I was going to ask you about last year, and just to touch on that a little bit, I know just after looking at like year-end recap, seeing those numbers, it was pretty incredible what you and the mortgage team and where we were 3 years ago, you know?
We doubled the amount of business that we would normally do in a year's time. So we actually tripled the amount of business from when I started here in 2017. But from 2019 to 2020, we increased the business 100%. And January is already January was already a good month. February is looking to continue that process where we exceeded our goal for January and will likely exceed our goals for the rest of the year.
Amazing.
Oh, yeah.
Love it.
It looks like we actually have our first question, and that's, how do you pre-qualify for a loan, John? Do you want to touch on that and tell our viewers?
Pre-qualifying is rather easy. You can give any one of our mortgage lenders a call or give me a call. And if you want to take the time to do it over the phone, we can take the application over the phone. But we often recommend that you come in person, especially if you're a first-time home buyer. But we also have an online application process where we can send you a direct link to my individual or the loan officer's individual webpage that has an application. And then as soon as it's queued up, it notifies them that the application is ready for them to process that. We don't have to have pay stubs or any documentation to do a pre-qualification. We'll pull credit, and based on the income that they tell us, we'll verify everything and qualify them to see how much they would qualify for.
Great. And John, this is something I always wonder too, is do you do that? Do you get pre-qualified before you meet with a realtor, say, or should you, what part, what step of the process, I guess?
And that's a great question, because 36 years ago when I started working, you didn't do that. The idea of pre-qualification was just, it wasn't there. Nowadays, most real estate agents would prefer for you to pre-qualify before you start looking for a house. Not that you can't contact them, they would happily talk to you, but by pre-qualifying, that gives them a better idea of what price range you qualify for, what loan programs you qualify for. So as a good example, if you only qualify for the USDA Rural Development or FHA, they have some strict housing requirements that the house has to meet. So if the agent knows that in advance, they know not to steer you towards a home that's going to be a fix-up situation that won't qualify for USDA or FHA. So pre-qualification is very key before you go start looking for a home.
Yeah, I agree. I would say then you kind of know your price range too. I mean, you know your budget, you know what size home you can fit into.
Absolutely. And it's great to know what your price range is, but over the past 2 or 3 years, I've really noticed even more than the price range, it tells you what kind of program you're going to fit into. And it also tells you, then we can scope and model what kind of homes you need to be looking for. Another example is people will pre-qualify and then they'll start looking for homes and they'll find a manufactured home. Not all loan programs can we do a manufactured home. So again, if your FHA is a good example, if you're FHA or USDA qualified, we tell the borrowers, don't be looking for a manufactured home because those won't fit this program.
Sure. And I'm going to kind of back you up there because I know that's a lot of bank terminology that we use together quite often, but I know Farmers offers a wide range of products for our customers. Can you explain what those are? I know you said
Sure.
The different types of loans we offer.
Correct. One of the good things about working with Farmers State Bank is we offer the full array of mortgage products out there. Now, there'll be some specialty products that some institutions on the internet may have that aren't really a loan program. They're more a hybrid product from that company. So what we have available is conventional financing, which is the traditional fixed rate loans that people are looking for that have 5 to 20% down. We offer FHA, which is Federal Housing Administration. That's a government program. We have USDA Rural Development, which is another government program through the Department of Agriculture. We have VA, which is another government program through the Veterans Administration. And then in some cases, we will have the availability to do in-house financing. So many institutions don't finance on manufactured homes, as an example, or even a single-wide mobile home. If a borrower is looking at a single-wide mobile home that's sitting on land, we do have a product for them to do that on an in-house loan basis. So we cover from first-time home buyer to your 10th home buyer. We can pretty much cover it. We can do out-of-state financing. Since we're a state chartered institution, we have the ability to lend in all 50 states, and our footprint definitely covers Illinois, Missouri, Indiana, Kentucky, Tennessee. And because of connections, Jill, that you have in Minnesota, we've actually made some loans in Minnesota this year. And then
I
we
was
have
just going to say.
Yeah, we have a lot of snowbirds in Southern Illinois that go to Florida, so we do a lot of financing in Florida.
That's awesome. That's really awesome.
Yeah. You touched on the first home. Could you elaborate a little bit about the first time home buyers program and maybe what determines which loan that they fit with?
Sure. The first time home buyers programs are sometimes overused because first time home buyer is kind of a marketing catch. Most loan programs, really all loan programs, aren't restricted to first time home buyers. But there are three programs that we offer that are very unique and used for first-time home buyers. The first one is the USDA Rural Development Program, and that's because it does not require a down payment. So it's a great program. You don't have to be a first-time home buyer, but it's a great program for those that are first-time home buyers. The next one is FHA. Again, it's not exclusive to first-time home buyers, but that program, because it only requires 3.5% down, is another program that works well with first-time home buyers. And then with Freddie Mac, with conventional loans, you typically do have to put 5, 10, or 15% down. If you happen to be a first-time home buyer, we can do a conventional loan with as little as 3% down. So we have three products there that work well with first-time home buyers, and we would be happy to sit down with a home buyer and say, let's see which one works for you.
So you're saying that all the marketing that you hear out there that says, here's a first-time home buyer product that we have, it's actually a product anyone can apply for. It's just
right. For the most part, they're products that anyone can apply for.
Okay.
But because first-time home buyers are looking for a low down payment and a low interest rate, we utilize these products in order to fit to a first-time home buyer. Now, occasionally, the state of Illinois or the federal government will offer a grant program to first-time home buyers. Currently, there's not any grant programs. The state of Illinois has got a program where they will lend you some money for a down payment, but the downside to that program is you pay a higher interest rate on your first mortgage.
Okay.
That's where they get the money back to cover those grant programs. So if a customer has a question about that program, I would be happy to sit down with them and show them why I think the USDA program is a better fit than that grant program that the state of Illinois. About 10 years ago, we saw the state of Illinois offer that first-time home buyers grant program where they gave you $7,500 as a tax credit. The federal government did that probably 15, 16 years ago with an $8,500 credit. Haven't heard that any of those programs coming around anytime soon. usually if the housing market is strong, we don't see those programs. They come around when the housing market is weak. And
I remember seeing that right when I graduated from college, and that was kind of during the 08, 09 crisis or
when
recession. So we saw tax
the
and I know
the meltdown was happening, and they were trying to reestablish some home buying to first-time home buyers to get them into the market. Absolutely.
Great. Well, we have another question here. I'm going to throw it up on the screen, John. It is, how long can you finance a home?
Great question. You can go as long as 30 years. Now, if you're in different markets, there are some markets that will have not a conventional loan that will go 40 years. Like Chicago, as an example, may have some special programs, but traditional conventional loan programs will go a maximum of 30 years. Now, interest rate wise, you can get a cheaper interest rate if you can go 20 years. You'll get a cheaper rate if you go 15 years. So the shorter the term, the better the interest rate. But on average, your term is going to be a 30-year mortgage.
Okay.
And speaking of interest rates, not to jump ahead really, but I know right now interest rates have been lower than usual. So could we maybe talk about people that want to refinance their home for the first time, or maybe they're looking into refinancing while rates are lower?
Yeah, as a matter of fact, rates are starting to trickle up. I guess trickle would be down, so maybe we should say they're starting, they're starting to tick up. So if you haven't refinanced, it's a very strong time to probably do so in the next 30 to 60 days. I don't think we're going to see a major increase in interest rates, but for example, a 30-year fixed rate, instead of being below 3%, you're probably starting to see the average rate above 3%. So a borrower will want to call us, and credit score is going to factor into your interest rate. Loan amount is going to factor into your interest rate. So it's very key for them to call us and say, here are my circumstances. What kind of rate can I get you? If you're paying above 4%, you still have a great opportunity to refinance. If you're paying below 4%, it's really critical that you talk with the lender and let us crunch the numbers for you so that we can determine whether it's going to save you money.
With closing costs and everything too, of
right.
course.
We typically, the industry says you want a rate that's 1% cheaper than what you currently have to make it worthwhile to refinance. But if somebody's got a $25,000 loan that they're going to pay off in the next 5 years, there's not any reduction in rate that's going to help you. Your closing costs are going to be more costly than the savings and interest rate. So the 1% is a good guide, but it's always good to talk to the lender, and we're happy to crunch the numbers for you.
Great. There was another comment here that I just wanted to throw up on the screen. So that was kind of what we just went over, is how do I know if it's a good time to refinance? And that's anytime the interest rates are 1% below what your current rate is.
Right. And just to kind of probably add to that question to Angela, in addition to the interest rate, I always ask my borrowers, I say, take this opportunity, especially if in their gray area. I call in the gray areas when you're probably 3/4 to 0.5% cheaper. So what I'll ask them to do is I'll tell them, and if they don't have the paper, I'll give them the paper and a ledger sheet. And I say, put this in a central spot in your home, kitchen or bedroom, and take the time over the next 3 to 5 days as you're walking through your home, write on that sheet of paper anything that's worn, dreary, needs to be painted, needs to be fixed, older, anything that may need to be replaced in the next 5 years. So what we can do then is for anybody that's looking to save money, it's also a great time to look at paying for any repairs and improvements by refinancing. Take the cash and equity out of your home to cover those improvements. Because again, with 36 years of experience, I've seen in my early years, we would refinance somebody, and then a year later they would come and say, oh, my furnace just broke down. I've got to refinance all over again. If rates went up, we often see having to give them a home equity line of credit, whereas if they would have thought about it a year ago. So it was probably a decade ago that it finally stuck in my brain to start asking my customers, take the time to walk through your home and see if there's any improvements that you need to make, and let's package that all into one package and save you money at the same time.
That's so smart. I love that. Good advice.
I'm so glad. Yeah. Killing two birds with one stone right there. But I'm so glad that you brought up home equity lines of credit, because we have another question from Miss Katie Barter she asks, how does a home equity line of credit work? You want to walk us through that process?
Yes. These are all great questions, and we get them daily. So a home equity line of credit is a second mortgage. A lot of people don't understand that. It is a loan against your house. We file another mortgage on your home. But what we do is we get an appraisal, and then we will lend up to 90% of the appraised value minus your first mortgage. So I'll use some simple numbers. We'll say it appraised for $100,000. We'll do up to $90,000 minus the balance of your first mortgage. So if your first mortgage is $80,000, then we're going to give you a $10,000 line of credit. If your first mortgage is only $50,000, you can qualify up to a $40,000 home equity line of credit. The line of credit is like a credit card where you don't have to take all the money at once. You have access to that money for up to 10 years because we do a 10-year home equity. So you can borrow as much, use as much as you want, and you're only paying interest on what you use. And as you pay that money back, then that's money that you can reuse. So as an example, I've had a home equity line of credit on my house that I used to do some repairs a few years ago, some flooring and stuff. And fortunately, I've paid that to a zero balance. Right now, it's just sitting there for me to use. If some repairs come up, I can use that. I don't have to go to the bank and get another loan or request or go through paperwork. If my air conditioner goes out and I need $10,000 to cover it, I can take that out of my home equity loan.
Smart.
So a lot of people will think I don't have a need for a home equity loan. I always encourage people to have a home equity loan, even if it's sitting at a zero balance. It's there. It's automatic funds that you have available to you whenever you're going to have a home repair that you need in an emergency. It was 2012 when my wife and I and boys went on a vacation, and we came back and it was 90 degrees, or no, it was 100 degrees inside our house. And I knew that my air conditioner and everything was on the fritz, but it went out while we were on vacation. It was too hot to stay in the home, so we ended up spending a couple of nights at the hotel. But I have a house that has two systems, so it cost over $14,000 to both systems. Unfortunately, went out at the same time. So that's where that home equity comes into play. There's
always a need. Yeah, there can always be a need.
So you're always going to have a need for one.
Yeah.
Absolutely. That's not a fun thing to come home to from a
No, that was
way.
Oh, man.
Very expensive.
Oh, man, I guess. So I have a question, and it's about the down payment on a house. How much should I save for? If I'm a first-time home buyer and I have no idea where to start, where I don't have a relationship with my mortgage lender, I mean, I'm brand new. First of all, I guess, how should I build my relationship, or how should I reach out to a bank? And then secondly, how do I know because that's my thought, is that I have to have this down payment ready to go, all of it saved before I even step foot in the bank to ask or talk to a mortgage lender.
And that's a great question, because I've gone around over in past years and talked to Rotary clubs and high schools, and even John A. Logan College did a discussion at some of their real estate classes, and I was not able to, or I was able to communicate to them the idea that you don't have, even if you're looking to buy a year or two from now, take the opportunity to get pre-qualified. I'm going to turn my phone off here so we don't get but to take the time to get pre-qualified so that you know whether you do need to save money. For an example, over the past years, I've had a couple of people that I encouraged just come in and see me. They thought for sure they had to wait and either pay something off or save up some money. And I was able to qualify them for that USDA program. I said, you could go out tomorrow and start looking for a house. And they were flabbergasted. Now, what I do tell people is if you think you're in the market, obviously we want to promote Farmers State Bank. Come see me or one of the mortgage lenders at Farmers State Bank. But also if you're uncomfortable with that cold call, talk to your parents, talk to a relative and say, who did you use when you bought your mortgage loan, and get that word of mouth referral. Probably you're going to get a word of mouth referral to Farmers in many cases. Go and see that lender and say, I've worked with some young couples, students directly out of college, and they said, I'm not going to be buying for a year. And I said, that's fine. And so we've walked through their credit. I pulled their credit, showed them their credit. I said, here are some things you should try to work on paying down. Here are some things that you may want to pay off. Here's what you could, if you wanted, here's what you could qualify for today. But if you paid this off, here's what you could qualify for after you pay that off. So in some cases, it's not about saving money for the down payment. It's about, hey, I need to get this student loan paid off, or I need to get this car loan paid off, or rather than having a $700 vehicle payment, I need to, if I want to buy a house, I need to get rid of that vehicle payment and get it down to $200 or $300, and then I'll have the income and my debt structure will be such that I can buy a home.
So get your finances in order.
Right.
Yeah.
But I do, as far as a general figure, I try to encourage people to have 5% of whatever buying range that they are going to be in saved up, because even if you don't need it for a down payment, you're going to rapidly see, if you buy a new home, just window treatments are going to cost you a couple $1,000s. Painting is going to cost you $500, $600. Even
moving trucks.
Moving trucks.
Moving trucks are.
And then whatever comes back on the inspection, I mean, you just never know that too.
Well, and the inspection fee, which is an upfront fee for your inspector, is $350.
Yeah.
So you do want to have some money saved up for some of the ancillary expenses that are going to be related to buying a home. So if somebody comes in and says, John, I've got a 5% down payment, the first thing I do is say, well, let's see if we can hold that 5% for all these expenses you're going to have. And let me see if I can qualify you for 0 down or 3.5% down, so that you can keep some of that money in your pocket.
And again, you said the conventional loans, the FHA loans, and a USDA loan, you can just put down what, 3.5% or 3%?
With a conventional, you can put as little as 3% down. With FHA, it's 3.5% down. With the USDA, it's 0% down. Now, one thing added though to those programs, whenever you have less than 20% down, you're going to have something called mortgage insurance tied to your loan. This is insurance that covers your house. This isn't insurance that covers you in the event of a death or a disability. This is insurance that covers the bank in the event that you decide to quit paying for that house. So it's what we call default insurance. You've defaulted on the loan. So just know that if you're not going to have 20% down, whether it's a government loan or whether it's a conventional loan, you're going to have a form of mortgage insurance to some dollar amount added to your monthly payment.
Okay, so that'll be included in your monthly payment automatically?
Yeah. It's all.
And it's not that bad though. For those of you watching, it's not that bad. I've rented for years, and I just recently purchased my own, my first home, and it's not that bad. I'm actually paying less than I was.
Yes, Emma, we just went through that process with you. What, has it been a year yet?
Almost. In May, it'll be a year. I can't believe it. I feel like I'm always saying time flies, but it does. So
exciting, Emma. And that, I think it's usually, whenever I see it, it's abbreviated as PMI. Is that correct?
Mm-hmm.
Yeah, and let me explain something, because that gets really confusing.
Okay.
PMI is abbreviated for private mortgage insurance, which means it's a private company that provides that insurance. We use two companies for that, one called MGIC and another one called Genworth. So it's not insurance that the homeowner has to shop for. This is something that the bank will already have prearranged. Okay. Now, the government programs, FHA, VA, and USDA, many things like the government, they like to use smoke and mirrors. They don't call it PMI. VA calls it a guarantee fee. It's an upfront fee that they charge and add to the loan. It is right now, it's 2.6% of the loan amount is what the VA charges to a homeowner for that mortgage insurance, but they call it a guarantee fee. FHA has both a monthly fee and an upfront fee that they charge, and they call it MIP, mortgage insurance premium is what they call it. And then USDA, they have a small upfront fee and a small monthly fee, and they call it an annual fee. So government gets creative on calling it so that they don't have to say PMI,
right?
And other things. But just know, as a homeowner, I tell homeowners, just know that if you don't have 20% down, you are paying mortgage insurance in some form or fashion.
Okay.
And I don't know, those of you watching, if you saw our banner, but if you like and share this video, you can get $100 off on closing costs whenever you apply for a mortgage with Farmers State Bank. So like and share.
Maybe we can touch on closing costs and what those look like, since we're talking about closing costs.
And you know, again, all great questions, because these are the type of questions I answer for borrowers on a daily basis. You can really get caught up in high closing costs or moderate closing costs or low closing costs, depending on who you use. Here at Farmers, we really promote utilizing the local community bank like us. Our closing costs are minimal. They are generally third-party fees, which is the appraisal, the title work, recording fees, credit report fee. We have even what we call a flood certification fee. A lot of people don't realize that with every mortgage, we have to verify whether that property's in a floodplain or not. That's a fee. That's a $24 fee. We have to use what's called a tax monitoring agency that monitors whether you've paid your property taxes, because property taxes would be a lien on your property. So we have to pay a company to monitor that. That's another $85 fee. So there's all these little fees that you have to pay for. With the larger internet companies, they're going to charge often a large origination fee, and they're also going to scrape off the top a premium from all those fees. So you could see with some of these internet companies, $3,000 to $5,000. I've seen as much as $10,000 in closing costs before. With us, it's pretty moderate. I always tell borrowers it's for an average size loan, you're going to pay $1,800 to $1,900 in closing costs. For a higher loan, the title work is going to cost a little bit more. So something above $250,000, you may get into the $2,000 to $2,500 range, just because the title work is more expensive.
John, could we back up and what would you classify as like an average sized loan?
An average size loan for our market's going to be $125,000 to $150,000. That's where our average loan falls these days. Now, obviously, there's loans much larger than that. We see loans in our market up to $250,000. We're now starting to see some of the higher priced homes sell. So we're seeing in the market $300,000, $400,000, $500,000 transactions. But average purchase price, I think in Southern Illinois, is somewhere in the 150 to 200 range. And then with down payment, we're seeing often about 125 to 135,000, I think, is where our average loan size runs.
Now, are closing costs factored into that 3% down payment for those programs we mentioned?
Great question. Again, closing cost is an out-of-pocket expense in addition to your down payment. So a lot of people don't realize, they always think, well, can't you just roll the closing cost into the loan? No, closing cost does have to be an out-of-pocket expense. But if you work with a loan originator who's done this for many years, like myself, we're going to show you some tricks of the trade. And one of those tricks is you can ask the seller to pay your closing costs by offering maybe a little bit higher price. So if you're going to offer $100,000, maybe you offer them $102,000 and ask them to pay those $2,000 in closing costs. And that's completely legal to do that, completely legitimate to do that. So you do, in a sense, roll it into your financing that way, but it's a way. But you don't have to offer a higher price. Any price that you offer, you can say from the very first, I want you to pay my closing costs, and then that way all you have is your down payment out of pocket.
Right. Right.
Something to consider.
Why I tell people to have that 5% as an approximate, because if you work with a seller who just says, I'm absolutely not paying any closing costs, then you may, even if we can get you into the rural development loan with no down payment, you're still going to need some money to cover those closing costs.
I know we kind of talked about the inspection and the appraisal for closing costs. Are we as the buyers in charge of contacting those, or does the bank have specific ones they work with? How does that work? Like, how do I reach out?
The home inspection is the responsibility of the homeowner. So you want to work with your real estate agent. They'll have some that they will recommend. That is an upfront out-of-pocket expense. That's one thing that's not part of that $1,800 to $1,900 that I mentioned. Appraisal, title work, and all the other things related to the house purchase that the bank is involved in, the bank will take care of having that done. So we will contact and order the appraisal. We get the title. We work with the real estate agent to get the title work done. We deal with all the other companies related to pulling your credit, the mortgage insurance, things of that nature. So the two primary things, well, let's say three primary things for a home buyer to that they're responsible for is: one, finding the home; two, getting their home inspection; three, arranging for their homeowner's insurance.
Okay.
Those are the three primary things that they're responsible for when they decide to buy a home.
You mentioned credit. Let's talk about credit for a little bit. Is there a minimum that we can accept for certain programs, or
A credit score?
There is. For farmers, the programs that we work with currently require a 660 or higher credit score. Since the time of COVID, we've seen credit get stricter and these programs are stricter on credit, because prior to COVID, we saw credit scores as low as 620 being the minimum credit score. And so they've moved up those credit limits. But you can talk with different, even though, I would encourage people to come and see farmers. If your credit score is below 660, there are other institutions out there that might go a little bit lower credit score. They'll take on a little bit higher risk. But if they do, they're probably going to charge a higher interest rate along with that risk. So interest rate is always going to be based on risk. Here at Farmers, we're not into that risk return relationship. We work with Freddie Mac and their standard rates, and then so that's where we have that minimum credit score.
So 660.
660 is what a borrower wants to strive for. Now, one thing that I'll add to that, because a lot of borrowers will use Credit Karma and some of these third-party companies, those are not what I would consider a true credit score, because they're scoring it themselves, and those are not credit bureau agencies. Those are third-party credit. Not even sure what classification they put themselves in, because the three credit bureaus is TransUnion, Experian, and Equifax. And even within those companies, there are 10 different scoring models. And the scoring model that we use is the one that's required by Fannie Mae and Freddie Mac for mortgage scoring. So I kind of break it up into, even though there's about 10 different models out there, I break them up into 3 models. There's the consumer credit score, where the consumer is going out and pulling their credit and saying, okay, what's my score? There's information that's not tied into that score. Why the credit card or credit companies do this, I can't give you a good answer, but that consumer score is going to be much higher. There's a consumer loan credit score, the type of credit score that is pulled when car companies and car lenders are providing a car loan for you. And then there's the mortgage credit score, which is the strictest one out there. So if you have a 660 with Credit Karma, it's very low. When we pull that mortgage credit score, it could be as much as 100 points less than that score. So you always want to get with the bank and have the bank pull your credit to determine where your credit score really falls. Now, after that, that Credit Karma can be a benchmark where if you know they're 660 and my score was 560, you know that you need to get to probably 740, 760 before your credit score is going to be 660 with me. So you can use it as a benchmark, but it's not an accurate score.
Sure.
So interesting. I wanted to go back to a question. I know Jerry Edwards posted something when we were talking about home equity lines of credit, and I just am going to throw it up here and hope that, John, you know what it was in reference to. It said, if you pay off a loan early, can I get that back? And I think it was around the time we were talking about home equity lines of credit. And Jerry, if you want to chime in here and clarify, that would be super helpful. But
yeah, I'm not quite sure. I know Jerry and hi, Jerry. I'm not sure what the exact is, but it may be if you've paid off your loan, can you still get a home equity line of credit? And yes, you can. You can always get a home equity line of credit. If you've closed out your home equity line of credit, you can always get a new one. Generally, home equity lines of credit are about a 10-year type of loan. And then the bank either renews it or you pay it off. There are some institutions, PMI.
PMI, it looks like.
Yeah.
So good question, Jerry. Thanks for clarifying that. On PMI, no, that there's no, PMI is now set up to where it's not refundable. So it's a little bit cheaper. 30 years ago, PMI was paid at a little bit higher rate, and it did have a refund option when the loan was paid off early. Now it's called monthly PMI based on what your principal balance is. So the PMI just stops at that point in time. So PMI is not refundable. Now, I will go back and say there's a caveat to that with FHA loans. If you pay a FHA loan off early, because there was an upfront premium to FHA, you can apply to FHA to get a refund. It's prorated, and I would put it in the context of proration like your car tires. It's used and collected heavily on the front end, and so you'll get a very small premium rebate from FHA if you pay your loan off early, but because of that upfront premium. VA, you do not get a refund for that VA guarantee fee. There is no refund on that for paying your loan off early.
Okay.
just rolls off when you hit that 20%.
The best way to save yourself money is to have 20% down, but not everybody wants to wait until they save 20% to buy a home. The critical thing is, though, what you can do is you can get into a home with 5 or 10% down and then just make extra payments on that loan. Usually, if you make extra payments within 4 to 5 years, you may be able to eliminate PMI by getting your balance to that 80%. So that's another good reason to go with a conventional loan. When you reach that 80% loan to value, PMI will drop off. With the government loans, that PMI or that premium that you paid is for the life of the loan. So there's no drop off point to the FHA premium, no drop off to the USDA premium. And again, no refund from VA if you get to 80% sooner than you thought.
Okay. Good question. It looks like Ine asks, what is your minimum score for qualifying for a loan?
Okay, we'll circle back to that. With our programs, 660 is our minimum score to qualify for our loan programs. There may be some loan programs out there with other institutions that will go lower. 640 tends to be the very lowest that you can go. But there may be institutions out there that will go down to 600. But you're generally going to pay for it with a higher interest rate because of that risk-reward calculation. If they're taking higher risk, they're going to reward themselves with a higher interest rate.
Great. I wanted to ask you this too, John. It's more about the process of the loan process. And I know one of our most common, maybe not complaints, but questions is why does it take so long for a mortgage? Why is the mortgage process so long?
That's the biggest question we get is how long is it going to take? And then when we say how long, they're just astonished because nowadays everybody's used to buying a $50,000 car on the spot on a Saturday morning. And mortgage loans aren't that way. Because there's so many regulations tied to a mortgage loan, it is a lengthy process. So one, we've got to collect all the documentation from the borrower, and there is a lot of documentation that they have to provide. It's just not a matter of you tell me what your income is. We generally got to collect 2 pay stubs. We've got to collect 2 years worth of W-2s. If you're self-employed, we need 2 years worth of tax returns. We need 2 months worth of bank statements to see that you have the money in your account for 60 days to cover the down payment and that there hasn't been any strange deposits into your checking account. The appraisers are busy, as is everyone. So just because we order the appraisal today, it's not going to be that they can do it tomorrow. So appraisals take 2 to 3 weeks before we get those back, and then it has to be reviewed by somebody. Title work is the same thing. Title companies are backlogged with title orders. Just because I order it today, they can't fulfill that order tomorrow. It's going to take them 2 weeks generally. And some are faster than others, but generally we allow for 2 weeks for the title work to come in. We then, with everybody, your file, you just don't see a loan originator anymore. The loan originator is only one part of that origination underwriting process. With mortgage loans, it does have to be underwritten by somebody in addition to the mortgage originator, so it has to go to an underwriter. It's going to probably take a week from the time that they receive it to the time that they get to that file. So we tell people right now, average closing time from start to finish is about 45 days. There are times where if the appraisal and title work come in a lot faster, we can get it closed in 30 days. There have been some emergency situations where we've been able to push it through faster than that. But that's not something we can do on every file. We can't put a rush on every file and close it in 21 days. And government has put some regulations in that once you put your application in, we have to give you disclosures within 3 days. We have to allow you a certain period of time to shop. So we can't even close a loan inside of 10 days due to regulations. Once we have all this, we have to provide a closing statement to you 3 days before the closing. So we have to work with the title company to do the closing statement, and then you have to wait 3 days in order to close the loan. So there's all these pieces to the puzzle that we have.
So many wheels turning. Yeah.
Right. So what I try to tell people is I say, look at it in the context of how long would it take you to put a 5-piece puzzle together? And that's about the length of a car loan. Now take a 1,000-piece puzzle, and how long is it going to take for you to do a 1,000-piece puzzle? And that's the reference to a mortgage loan.
Yeah, about 35 days.
That many pieces that you have to put together to make it all fit to do a mortgage.
Got it. I know we were talking before this, kind of our product that we had going once was, Emma, and you know more about this too, is when you lock in your price with.
We were calling it the 𝗫FSB Elite Mortgage. So maybe some of our viewers have seen that on our marquee signs, or maybe some ads we've published. But yeah, would you touch on that, John, a little bit?
And even like when you lock in your mortgage or your interest rate, how long do you have, before you have to close on your home?
And even credit score requirements for this loan as well.
So when interest rates are flat or declining, there's not as much a need for it. So heading into this year, there may be a little bit more of a need for looking at what we call lock, shop, and close, which essentially is we can lock your rate 90 days from the time that we can actually close on the loan. So we can do a 90-day lock. Now, that doesn't mean that you can wait till the 89th day to find a house. Mm-hmm. So the premise is that gives you 60 days to shop and get into contract in 60 days or less. And then that gives us 30 days to close the loan. You do have to pre-qualify for that, and you do have to have all of your documentation submitted in order to lock the loan. So we have to have all of the pay stubs, bank statements, tax returns and W-2s, because we have to have your loan fully qualified so that all you have to do is shop, send me a contract, I'll get the appraisal and title work done, and then we're ready to close. If we were having to wait on documentation from the customer, that's obviously going to delay the process. Mm-hmm. So in order to guarantee that lock, shop, and close guarantee, you need to provide all of your income documentation, all of your backup documentation. Once we have that, we can do a rate lock. You can then shop for 60 days and then be sure to have that contract to us, and then we can close in the time that it takes to have that finalized. So as rates are starting to increase, if somebody knows that they're definitely shopping for a home, that may be something that they're interested in doing. Now, conversely, if rates drop, we don't necessarily have the ability to change that rate. So that's the downside of doing that extended rate lock, is you are locked into that interest rate at that point.
Good to know. We have another question that came in, and it's about credit limits, and it's from Jerry again, and it says, does your credit card limits on all your cards take up available credit?
It does not. What we are focused on with your mortgage loan is your payments. So we're not concerned with if you have a $10,000 credit limit and you have that up to $9,000, that does not limit your buying power other than the payment itself. So we want to see that your debt to income ratio, which is all your monthly payments against your monthly income, is no more than 45%. So you want your monthly. So obviously a higher balance on your credit card is going to mean a higher monthly payment, but that balance itself does not affect. So as an example, if you're looking for a $250,000 home, what balances you have on your credit card don't drop that amount at all. We don't factor that into that total home purchase price. Now, I will say, since we're on the subject of credit cards, one of the things that you can do, since you're going to be looking at a home, is keep your credit card balances less than half of your credit card limit. So if you have a $10,000 credit card limit, make sure that your balance stays below $5,000. Because anytime that your credit balance is above 50% of your credit limit, you're getting as many negative points as you are positive points on your credit score. And so if you've got your credit card maxed out, that's probably more negatively impacting your credit than it is positively impacting your credit.
That's good to know.
So, that 50% limit is, and now some will say it needs to be 30%. Some will say 60%. I've found that 50% is easy to remember off the top of your head, and it's an easy guideline to go by as don't utilize. So, and some people have asked me before, so should I consolidate a credit card? If you've got two credit cards that have $10,000 credit limits, and you've got each of those up to $5,000, no, I would not combine those into that one credit card, because now that credit card is maxed out and you're going to get many negative points on that. So, you know, a lot of people will do credit card consolidation on a 0% credit card. Don't ever max that credit card out at that 0% interest rate, because it's damaging your credit more than it is that 0% interest rate.
That's so good. I have a question, because I know working with the bank, this is something that we speak about a lot, but what are some of the biggest mistakes people make? I know purchases that people make before their mortgage, they close on their new home.
That is a fantastic question. And I hope borrowers as well as real estate agents listen to this. When you go into the mindset of I'm going to buy a house, you need to exclude the mindset of buying anything, changing your lifestyle, changing your job, changing your credit. So you don't want to go into buying a home on December 1st knowing that you're going to be using your credit card during the Christmas season, because that's going to foul up your credit, and it's going to cause you, the buyer, a lot of paperwork for the bank. So don't go make any large purchases. Don't make any large transactions on your credit cards. Don't borrow for anything additional. Don't apply for anything additional. Don't buy that new Dell computer and apply for a Dell credit card to finance that computer when you're in the process of buying a house, because all that will impact your ability to buy the home. And we have had situations, even here at Farmers, where we had to turn a borrower down right before closing because they went out and bought furniture or they went out and bought a vehicle. We have to evaluate your credit right before closing. And if you've done anything that negatively impacts your credit, that's likely to get the transaction pulled.
Good advice. Don't buy that car.
And to that, 90 days, same as credit, is still a credit transaction. So I've had borrowers say, well, I went to the furniture store and they just said it was 90 days, same as credit. I just took the 0% for 90 days. They're still applying for a credit at that point in time. They're still signing a credit document, and we have to figure in a monthly payment into that. And there have been borrowers who have been affected that we had to say, no, you need to go pay that off now because it doesn't factor into your debt ratio.
Awesome. Good to know. Well, John, it has officially been 60 minutes of your time today. But before we end this live broadcast, if there's no other questions, I don't see any more from our viewers, but if you were to give one piece of advice or one takeaway from this live event today to our viewers, what would that be?
Well, when I go around and talk to different groups, and when I talk to borrowers, the one thing that I always tell them is buying a home and getting a mortgage is going to be the largest financial transaction of your lifetime, with the exception of retirement. Don't trust that process to somebody you don't know over the internet. Come in, get to know your local banker, come in and see us at Farmers and get to know us, because we're going to walk you through the process. We're going to teach you what you need to know. We're going to find the right product for you. So just as you're not going to trust the birth of your child to some doctor over the internet, probably the next biggest transaction is that buying that home. So I beg people not, you need to come and see your local bank, get to know your banker, and have them walk you through the process.
Amazing.
Excellent advice. You guys had some good questions. Thank you so much for tuning in. Jill, I'll pass it on to you.
If they wanted to reach out to you, John, or if somebody wanted to get in touch with you, they had some more questions just following up here, what's the best way to get in touch with you?
You can reach me on my email address at jstreuter@myfsb.com. So right there on my direct phone line is 715-1201. Call or text. And I'm always, I'll take text messages as well. So contact me, and happy to answer your questions anytime.
Thank you so much, John. We really, really appreciate all your advice.
Thank you.
I learned a lot.
Thanks, John.
Thank you.
Bye. Thank you.